Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to talk about how ACCY 504 Audit taught me to be a better investor. And ACCY 504 is the class on all things auditing in the University of Illinois Masters of Accounting program taught by Professor Mark Peecher and Angel Chatterton. And I think any investor or equity research analyst would benefit from an auditing class. And the reason is that most investors dread an accounting scandal. Why? Well, they land as a surprise because most don't have the time or competency to ferret out the scandal on their own. They're not going to invest if it's that obvious. So what are the tools of defense if you find yourself in a situation where accounting becomes an issue? And there are three. It starts with this idea that most accounting treatments are justified by an accounting standard codification memo. You have to justify all of your accounting treatments when you're an accountant at a public company. Number two, it's the audit risk model. You have to assess both on the management side and the auditor side through statistical analysis to determine if there's a high risk of material misstatement. And then third, what are the non-GAAP adjustments and looking at the reconciliations? Does something stick out? So consider Equinix. The audit risk model is inherent risk times control risk times detection risk. IR and CR is what is attributable to Equinix management. We think they probably have good internal controls, and there's probably enough ASC justification to say that there's not accounting manipulation going on. If you look at the detection risk side, it's hard to argue that the auditor is not doing their job. I think they've probably done a very good statistical sampling plan and have hit their tolerable deviation rate. And you see in the 10K critical audit matters being called out. They've probably done a superb job with the audit. So let's use an example to vividly illustrate some key differences here. And the key is looking at Equinix, this is about CapEx classifications. And what's important to note here is that there's probably a lot of ASC justification around where they're classifying CapEx and maintenance or growth, and we know that it's flowing through the cash flow statement. We know it's a real accounting number. Now look at Cano Health as a different example, and consider this idea of de novo losses add back to adjusted EBITDA. And in this case, the de novo losses were the losses associated with a new building being open for a year. It seemed to be an arbitrary number added back. It didn't flow through the financial statements. And sure enough, it turned out that EBITDA was significantly overstated. So what are the key learnings? First, most auditing is justified by an ASC memo. You have to do a lot of justification for your accounting treatments when you're at a public company. Number two, auditors can drive statistical accuracy with their audit. They're doing a lot of work to ensure that there is no risk of material misstatement. And then number three, always look at the non-GAAP reconciliations. If something sticks out like a red flag, follow it because that's going to be your savior. Thanks for watching. Always here to help with your capital markets, investor relations, and corporate finance needs.